Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. I had a one-on-one coaching last week about personal credit, and it made me realize something. Most people have been taught credit the wrong way. They've been told the same advice for years. Pay on time, keep your balances low, and do not apply too much and wait. And one day you'll finally qualify for the best rate. Now, technically, that advice is not false, but it is incomplete. And that's where I like to fill in some details, because when advice is incomplete, it can sound responsible without being very effective. And when it comes to credit, being ineffective can be expensive. It costs you higher interest rates, worse approvals, lower credit limits, more money out of your pocket, and fewer opportunities when you actually need financing the most. What the banks understand and what a lot of people do not is that credit scores are formula-driven systems. And whenever something is formula-driven, there are patterns, there are mechanics, and there are strategies. There are things that you can do to create faster movement than the average person realizes. And that's what this video is about. I'm going to break down the credit score loopholes that banks hope that you miss. And I'm talking about strategies that work because they line up with the way credit scoring models are built. And once you understand these mechanics, you stop treating credit like a guessing game and you start treating it like a system. And when you learn how to work the system the right way, your credit score can move a whole lot faster than people think. So without further ado, let's get right into the video. Let's start with one of the biggest credit score strategies out there, and that's going to be authorized user accounts. Now, we have discussed this several times on this channel when it comes to trade lines. This is still one of the most powerful ways to strengthen a credit profile, especially if you have a thin or a very young file, or if your file needs help with age, utilization, and payment history. Here's how it works. When someone adds you as an authorized user to one of their credit cards, that account can appear on your credit report. Not just the fact that you were added, but the actual account itself. So that means the age of the account, the credit limit, the payment history, and the utilization can all potentially show up on your credit profile, and this is huge. One of the biggest problems many people have is that they're trying to build credit from scratch with new accounts and low limits. Their credit profile isn't necessarily terrible, it's just lacking a lot of data. An authorized user account can change that very quickly if the right account is utilized. Now, this only works well if the account you're being added to is actually strong. That means the account should be old, the older the better, but it should also have excellent payment history. It should have low utilization. Ideally, the balances reported should be very low compared to the limit. I would say around 10% or less. And when that kind of account appears on your credit report, your profile can benefit in multiple ways at the same time. Your average age of accounts will improve, your total available credit can increase, and your overall utilization can drop. And your credit profile can look way more established. That's why this strategy can create major movement for people with weaker profiles. Now, the best case scenario is that you're being added to one or two accounts from someone who has proven they manage credit extremely well. So in many cases, that may be a parent, a spouse, a close relative, or an ideal source. Now, if you didn't have a family member or a friend that can assist you with this, then I do have a video on Trade Line Supply Co. I also have another video on Coast Trade Lines. I'm going to link those videos here, and I highly recommend that you watch those if you want to use an authorized user account strategy in the short term. It will temporarily boost your credit score, and maybe that'll be for approvals for credit cards, auto loans, or things of that nature. Now, let's get into another loophole that a lot of people completely miss, and this one really comes down to timing. But here's the catch. This strategy only works with older FICO scoring models, meaning anything before FICO 10T, and it also does not work with Vantage Score 4.0. But luckily, at the time of recording this video, those aren't the widely used sources. So if you're not fully sure what I'm referring to, go watch my breakdown of all the FICO scoring models. I'll link that video here. I also have my latest video on Vantage Score 4.0. You can check that one out as well. Now, most people think credit card utilization is based on whether or not they pay their bills on time. That is part of the confusion. Paying on time matters for payment history, but utilization is a completely different category. Utilization is based on the balance that gets reported to the credit bureaus, and in most cases, that happens when your statement cycle date closes, not when the payment is actually due. So that means you can pay your card in full every single month and still show high utilization if your balance is high when the statement cycle date cuts. This is one of the biggest misunderstandings in credit. Let's say you have a card that has a $3,000 limit, and throughout the month you spend $2,100 on that card. Even if you fully intend to pay the balance off by the due date, if the statement cycle closes with a $2,100 balance on it, the bureaus may see this as 70% utilization. And that can absolutely drag your score down. And this is where this strategy comes in. If instead you pay the balance down before the statement cycle close date, then the lower balance is what gets reported. So instead of showing 70% utilization, you might show 3% or 1% on the same card. It's the same spending, same money, but a completely different impact to your credit score just by timing when that payment is made. And this is one of the fastest ways to create a score increase if you have revolving balances reporting too high. And the crazy part is a lot of people are doing everything else right. They aren't missing payments. They aren't being reckless. They're just letting balances report high because nobody explained the timing. If you really want to tighten this up, you need to learn your statement cycle close date for each card and then start managing around them. Not your due dates, your statement closing dates. So that means if you have an application coming up, or if you're trying to maximize your score, or if you're trying to get the best approval tier, you want your cards reporting low balances before those statements cut. And a lot of people always hear that rule about keeping utilization under 30%. But again, I'll tell you this, I've said it before, if you're trying to optimize, 30% is not your target. Under 10% will always be much better. And in many cases, somewhere around 1 to 3%, it can be even stronger. Now that's the difference between basic advice and real strategy. Another major strategy is credit limit increases. A lot of people obsess over paying balances down, which is smart, but they completely ignore the other side of that utilization equation. Utilization is a ratio. So yes, lowering your balances helps, but increasing your limits also will help too. If you have $2,000 in balances on a credit card with a $5,000 limit, your utilization is sitting right around 40%. But if your total limit was to increase to $10,000 and the balance stays the same, you're now at a 20% utilization. Same debt, better ratio, and that means your score can improve without you spending less just because your available credit has expanded. Many credit card issuers let you request credit limit increases using only a soft inquiry. So that means no hard pull, no impact to your credit score from the request itself. Sometimes you can do it right through the app, and sometimes you can do it online. Sometimes you can even do it over the phone. Now that is a massive opportunity because over time, if you periodically request increases and you get approved, your overall utilization profile can improve dramatically. Higher limits also make your credit profile look stronger and more flexible. Lenders like seeing that other lenders trust you with larger lines of credit. Now, this is not something you do randomly every 2 weeks, but I would say around every 6 months or so, especially after income increases or lower utilization or consistent on-time payments. It can make a lot of sense to then ask for a credit limit increase. So don't just think like a borrower, you want to think like a strategist. You want to ask yourself whether your current credit limits are helping your scores or working against it. And I have videos that'll show you how to increase your credit limit with every single major issuer, whether that be Chase, American Express, whether it be Capital One. Check my credit repair playlist or check my catalog. You'll probably find one for every single bank, or you'll find one that's general how to increase your credit limit just overall. Now let's talk about something people do all the time without realizing the score cost, and that's opening too many new accounts at the wrong time. Every time you apply for credit, there's a chance of a hard inquiry, and every time you open a new account, your average age of accounts can drop. This matters because age is a factor in scoring, and I'm not saying never open new accounts. Obviously, you need to build credit, but there's a big difference between building deliberately and applying impulsively. A lot of people sabotage themselves because they're always chasing new account offers, some store discount or some retail card or some random financing plan or some card they saw online. Then they wonder why their credit age is so short, their inquiries are stacking up, and their score is not moving the way that they expected. If you're trying to maximize your profile for a major goal like buying a home, getting an auto loan, or setting yourself up for business funding, then you need to understand timing here. There are seasons for building and there are seasons for optimizing. When you're in the building phase, opening accounts strategically may make sense. When you're in an optimization phase, especially leading up to an important application, you need stability. You want aging, you want clean reporting. and you don't want to keep interrupting your own progress with unnecessary new accounts. This is one of those strategies people miss because they assume that more credit automatically means better credit. Not always. More accounts only help if they're the right accounts and they're opened at the right time and managed the right way. So here's my strategy. When I was rebuilding my credit, I picked 3 credit cards that I knew can actually get higher limits over time. That's why most of the credit cards that I picked were with Navy Federal, because I knew I can get $80,000 of a limit between all of these cards. So I got those 3 cards, I focused on those, and then after that, I did not apply for any personal credit cards. All the other credit cards that I got were all business, because business credit cards do not show up on your personal credit report. So now I have over 50 business credit cards with balances being used, and I don't really worry about my utilization because once again, it's not being reported. You can also remove the hard inquiries for business credit cards because they're not attached to your personal credit profile. So that way, if there's any credit card that I ever want, I just find the business version and then I can have it without it impacting my credit age, which I've said in the past. At one point, my credit score was in the 700 range, and the only thing that got me to 800 was letting my credit age. So that way I can still get the credit cards that I want while at the same time increasing my credit age to get to the highest credit score possible and maximize higher credit limits, all at the same time. Another major area where people fall short is closing accounts without understanding which ones matter most. You've probably heard people say never close a credit card, and that advice gets thrown around all the time. But like most credit advice, that's just too simple. The real issue is not just whether or not you close an account. The real issue is which account you close and what role it plays on your profile. So for example, your oldest account will always matter. This is going to help anchor your age. They show history, they show longevity. If you close an old credit card account that you've had for years, especially one with no annual fee, you may be messing up one of the strongest parts of your credit profile. On the other hand, not every account deserves to stay open forever. For example, if you have some newer store cards or unnecessary accounts, those can add clutter or maintenance with very little benefit. The smart way to handle this is to identify your core accounts, your oldest accounts. Those are your strongest bank relationships, and those will be the most useful cards. They deserve to stay open on your credit profile. So just be aware, your oldest credit card plus your newest credit card will give you your account average. So if you close your oldest credit card, the next oldest card will then make the average. So you can go from a 5-year average to almost a 2-year one, and that will hurt your credit profile. So again, random accounts that don't serve any purpose may not deserve the same loyalty, but before you close anything, you need to understand how it fits into your overall profile. You do not want to accidentally remove one of the pieces that's helping you keep your average age and utilization in a healthier place. This next part is huge because it changes the way that you think about credit completely. Now, most people think credit scores measure whether you're good with money. That's not really what's happening. Credit scores are measuring how well you pay debt, and that is completely different. You may be financially responsible, but still be reporting in a way that makes your credit profile look weaker than it actually is. You may pay in full, but you report high utilization. You may have solid income, but low available limits. You may have no late payments, but you still have a thin profile that lacks depth. You need to have a structured credit profile, and that's why people get confused. They think effort should automatically produce results, but the score does not grade effort. It grades the data being reported. Once you understand the reporting mechanics, you can shape how your file is seen without doing any additional work. You simply have to align your behavior with the scoring model. You learn what balances report, you learn how age affects your scoring, and you learn how limit increases change utilization. Now, I have an entire video that goes into great detail about how to structure your credit profile, and it's going to be some of the things that we talked about, but just much more in depth. If you want to watch that, I'm going to link that video right here. Now let's talk about a loophole that most regular consumers have never heard of, and that is called rapid rescoring. Now, this is especially important if you're in the middle of trying to qualify for a mortgage or a different major loan, and that's where time really does matter. Now, normally when you make improvements to your credit, there's a waiting period. When you pay down balances, then wait for card issuers to report it. You make a change, then you have to wait for bureaus to update. That process can take a billing cycle cycle or even longer. Rapid rescoring is different. When you're working with a lender, especially in a situation where you're getting a mortgage, they may have the ability to push an update and get that information faster if you provide documentation. So if you pay down a balance or cleared a debt or fix something measurable, your lender may be able to have that reflected much faster than normal. That matters because a better score during the application process can mean better approval tiers, better pricing, and better terms. Now, the reason this is so powerful is because most people think they need to improve their credit months and months ahead of time, and then they miss their shot. But sometimes improvements made close to the process can still count if handled correctly. And to be clear, rapid rescoring is not something that you can do by yourself directly with the bureaus whenever you feel like it. It's generally accessed through the lender during an active loan process, but knowing that it exists can change the way that you prepare, and it also helps you understand that score optimization is not just about what you do, but when you do it. So now let's bring this all together. If your credit score is struggling, the first thing you need to do is break it into parts. You want to look at your age of account, you want to look at your utilization, you want to look at your available credit, and then look at your inquiries. Look at whether your file is thin or has decent age. Look at whether you have access to strong authorized user opportunities. Look at whether your current cards have room for limit increases, and look at what your statement cycle close date is. If your credit profile is weak, sometimes authorized user accounts may be one of the strongest moves available to you. If your balances are the problem, focus on utilization timing first because that can produce some of the fastest improvements. If your limits are too low, start looking into soft pull increase opportunities. If you have a major goal coming up soon, stop opening random accounts and protect your profile. And throughout all of this, understand that credit is not just about being clean, it's about being optimized. There is a huge difference between somebody with decent credit habits and somebody who truly understands how to position their credit profile. The person with stronger knowledge often gets better outcomes, even if both people are doing the exact same thing. And at the end of the day, the credit system is built on rules. And once you understand those rules, you stop being at the mercy of vague advice. Banks would much rather have you believe that credit improvements are slow, mysterious, and mostly out of your control, because the longer you stay in a weaker score range, the more money they can make off of your lack of optimization. They're not going to sit down and explain the difference between balances, reporting dates, and which one matters for utilization. They're not going to remind you to request soft credit limit increases. They're not going to make a big deal about how much a strong authorized user account can reshape a thin credit profile. And they're not going to tell you that a few strategic moves can shift your profile much faster than people assume. And why would they? It helps you move out of the expensive lending tier faster, and it helps you stop overpaying. And that is exactly why you need to learn it for yourself. I want to thank you guys so much for watching this video. If you take anything away from this, let it be this. Your credit score is not just about time, it is about structure and understanding how the system reads your report, and then make sure that your report is sending the strongest signals possible. And once you have more control and stop being the person who just hopes for a better outcome, you can become the person who builds one. As always, I want to thank you guys so much for watching this video, and you have a wonderful day.